I am happy to introduce Robert Jackson, who's a professor at Columbia Law School in New York, who is academically engaged with empirical work on executive compensation and also does a lot of U.S. government-related topics for the U.S. Treasury and for the TARP in the wake of the crisis. And so it's great to be able to have him while he's here in the UK.
Well, thanks very much, and thanks for having me in today. Delighted to have a chance to share this paper with you. What I thought I would do, because none of you have seen the paper, right? So what I thought I would do is just spend maybe 15-20 minutes giving a very general background of what motivated the paper, give you a sense of what the findings are. It's an empirical paper. And then I'd like to take as many questions as I can, because the paper's still at a relatively early stage, so I'm in a position where I can take a fair number of comments. Also, I'm going to be presenting the work to the Federal Reserve in New York in a few weeks, and so it's particularly helpful to get insights about methods and things that you might think I should work on. So let me give you some background on the paper, which is called Executive Retirement Pay and Incentives. Just for background, so that you know, in the United States, it's very common, very well known, that top executives of public companies, and particularly their chief executive officers, their CEOs, receive a substantial amount of their pay in the form of retirement benefits. I'm going to say more about what I mean by retirement benefits in a moment, but a significant amount of their compensation come in this form, in the form of pay after the executive retires. And there are two competing theories in the academic literature about why this is true. One is known as the managerial power theory of executive pay. This first theory suggests that CEOs in public companies have a lot of influence over the directors who set their compensation. They can use their power in the boardroom to persuade the directors to pay them more and differently than they should. And when it comes to retirement pay, CEOs use this power to convince directors who set their compensation to pay them in the form of retirement benefits. Why? Because retirement benefits are not very clearly disclosed. And so this is a way for the directors to hand over money to the CEO in a way that investors and the public won't notice. And so it's a way for the CEO to receive additional compensation. So I wrote a paper that makes that argument, that executive retirement pay is a consequence of managerial power. But there's an alternative hypothesis, an alternative possibility. We'll refer to this as the optimal contracting hypothesis. And this hypothesis says, actually, the reason executives receive their pay in the form of retirement benefits is not because they use their power to influence directors, but because it's an efficient arrangement for everybody involved. And here's why. It's efficient because when the executive receives her pay in the form of retirement benefits, if the company goes bankrupt, she won't get that money because retirement pay is usually just a promise to pay the executive in the future. So it makes her an unsecured creditor of the company. And for this reason, the executive has reason when she got big retirement packages to be more careful in the management of the company, because if it goes insolvent, she'll suffer losses from the bankruptcy of the firm. The economists refer to this theory as a notion, as a concept of inside debt. That is, retirement pay is just a way to make the CEO a creditor of the company. And by doing this, the retirement pay strikes an optimal bargain. That is the exact right compensation for the executive by giving her reasons to manage the company carefully. Now, everybody, and I should say, as a matter of background, that a series of economists have written several papers in high-profile economics journals making the argument that retirement pay works as inside debt. A number of theoretical papers and empirical papers make that claim. But economists and everybody else would all agree that retirement pay can serve this purpose only if retirement pay is actually debt-like. That is, if the retirement payments to the executive behave the same way that payments to creditors would behave. And everybody agrees that that's the case, that it would only be true that retirement pay serves as inside debt if the payments are actually debt-like. And here's an important thing. Disclosure rules in the United States don't let us know, don't tell us anything about whether retirement pay for top executives actually is debt-like. It's impossible to know based on disclosures whether that's true. So what I do in this paper with a co-author who's a former student of mine is assemble new data that allows us to examine whether or not retirement pay for top executives really does behave like debt. And if so, whether or not the inside debt hypothesis is more likely correct, or whether or not the data suggests the managerial power view is more likely to accurately describe executive retirement pay. Now, I keep saying that it's important for the inside debt hypothesis to be true. It must be that retirement pay is structured like debt. And I want to say a little bit about what I mean by that. And I really mean three things. First, I mean that the nature of the payments, that is the value of the payments that are made to the executive when she retires, are fixed. And the reason I say this is that typically corporate creditors, the people who loan money to public companies, receive their pay back from the company in fixed amounts over time. So first we want to see whether retirement pay is actually paid out in fixed amounts. The second thing is typically corporate creditors have limited ability to accelerate their payments. That is, they're paid over a long period of time, and they're generally not able to speed up the payments, with limited exceptions in cases like changes of control. Corporate creditors have to wait for their pay over time. So we want retirement pay to look like that too if it's going to act like inside debt. And finally, in bankruptcy, and this is the third way in which retirement pay should look like corporate credit if it's going to serve as inside debt. In bankruptcy, we want the payment structure for the retirement pay to be like the payment structure that creditors have. So, in a bankruptcy in the United States, typically what happens is shareholders receive nothing or next to nothing. That's the typical result. So, bankruptcy is a binary outcome for shareholders. Either the firm survives and they have some upside as equity holders, or the firm dies and they get virtually nothing in bankruptcy. That's not true of creditors, right? As I say here, creditor payouts creditors tend to be entitled to some residual amount of the company's assets after it goes bankrupt. This leads to a very well-known problem in the United States, which is that in what's called the zone of bankruptcy or the zone of insolvency, shareholders systematically want the company to take significant risk. Why? Because in bankruptcy, they're likely to get nothing at all, and if the company survives, the shareholders are entitled to the upside. Creditors feel very differently, right? Because if the company fails, the cost of those losses in bankruptcy will be borne by the creditors. We need retirement pay to look more like creditor payouts than shareholder payouts in order for executive retirement pay to serve as inside debt. So we're going to explore whether or not it actually does. So in order to do this, we collected data for 21,000 executives, 2,100 public companies over a 6-year period in the United States. And we looked at two different types of payments, retirement pay, that are given to executives in U.S. public companies. The first are called defined contribution payments. And sorry to have to do this kind of detail on the nature of retirement pay, but it's important to distinguish between the two types of pay. The first is, as I say, defined contribution payment. It's quite a bit like a 401k, if you've got that, or even like a standard savings account. The company says to you today, I can pay you this $100 today, but rather than do that, I won't. I'll allow you to defer it to some later time. And at the time the executive says, okay, I won't get it today, I'll get it later, the executive agrees with the company to make an investment decision. That amount of money she would have received goes into some investment that the executive and the company pick together. Then at a later date, the executive leaves the company, and then after she leaves the company, the payments begin. These are retirement payments, so the company figures out how the investment is done and starts paying the executive. The thing to know is that this investment decision the executive makes, where she puts that money between the time she saves it and the time she retires, is not disclosed in public companies, and it's crucial because it tells us what the payment amounts will be for the executive when she retires. And remember, we said before, it's important that they be fixed payments if they're going to be like inside debt. But nobody knows whether they're fixed because this decision isn't disclosed, and I'm going to show you a little evidence in a bit about what they actually look like. So for this first type of payment, we have data on the amounts the executive had deferred, that is the amount that they said, no thanks, don't pay me, I'll receive later, and also how much they earned in the investments that they make. So those two things are disclosed in public companies, and we can get at that data. So we have how much they deferred and how much they earned, but nothing else about these types of payments. That's the first one we'll look at. And then the second type of retirement pay for executives of big public companies in the US are known as defined benefit retirement payments. And for many of you, this will be the more intuitive type of retirement pay. This is like a pension. The company promises, rather than where they say, when you retire, we're going to pay you some amount over time. And the executive at that time, as a matter of US tax law, is required to agree with the company when they'll receive the payments. So as a matter of US tax law, the company and the executive agree, we're going to pay you something later. The executive and the company say, this is when I'll be paid, upon my retirement, a few years after, etc. Then, of course, the executive leaves the company, and then the payments will begin on the schedule that the executive and the company have agreed. And the thing to see is that the decision the executive makes about when the payments will happen dictates how long it takes the company to pay her. And remember, we said before that an important way in which retirement pay would be like inside debt is to be payable over a long period of time, like corporate credit is. But it's not known, there's no disclosure as to when executives are paid when they retire from public companies. And so we try to get at that question in this study too.
Rob, maybe I get this, but what do you mean payments begin on a defined contribution? You know, if you have a 401k, what do you mean payments begin? You have the money. You know what I mean?
Right.
So you're going to get to this. I mean, I think of a typical investor in a 401k, they don't have a sense of payment begins, they just have a sense, oh, my 401k got larger.
That's right, you're exactly right. In a 401, so what I mean really is when the payments are actually dispersed as cash to the individuals. So you can look at your 401k and say it's got to be larger, but for you right now, you don't have access to it. It's a question of when the money comes out of you.
Okay,
Yeah.
that's what you mean. Okay.
Yeah, that's what I mean. So for these defined benefit payments, I know how much the company owes the executive, what the total amount they're owed is, and when somebody leaves the company, in the first year that they leave, in the same year that they actually retire from the company, I can see how much they're paid. After that, they disappear into the disclosure ether. They go into the darkness, and I can't see what happens next. But I'm going to use those data to try and get at some of the questions I've just raised about the structure of the payments. So we gathered data about 21,000 executives, for these details. We added more data on things like the company's leverage, their industry, firm size, lots of controls for a regression analysis, and we tried to look at these structural questions separately. Now, just to give you some summary statistics, I show you here that the average executive in our study is owed a couple of $1 million worth of retirement pay. I just give you a sense over time for each year in our sample. We've got a 6-year sample period covering 2006 to 2011. These numbers actually, to many of you who, or those of you who looked at this literature before, look a bit small. That's because in our study, we've got all executives, not just CEOs, but lower level executives in the company as well. If I would restrict this to CEOs, the numbers would be about 5 times as large. So significant amounts of retirement pay owed to these individuals. The thing I want you to see that's not well appreciated in this literature so far is that they're about equally divided between the two types of retirement pay. About half is defined contribution, half is defined benefit. And that's why it's important to understand the structure of these payments. Because if we're going to make the claim that they have an incentive effect, that they act as inside debt, we need to understand the different structural attributes of each type of pay. So I'm going to look at each one of those in turn. Let's start with defined contribution payments, the one that Tim was just asking about. Remember here, we're going to take a look at the way executives make the following decisions. So they're told, instead of receiving this pay today, you can get it tomorrow, you're going to invest it in some instrument. That instrument generates some earnings, which I can see, which are disclosed. And when those earnings are disclosed, what I can do is, even though I don't know what investment election they made, where they put the money, I can look at what they earned and then compare their returns on those investments to the company's own stock returns to see whether or not, of all the investments they could have chosen, they invested in the company's stock with their retirement pay. And the reason that's important, and I'll say more about this in a moment, is that you remember we said that the value of these retirement payments, in order to be like inside debt, should be fixed, right? And should replicate the payments in bankruptcy of debt holders, not shareholders. But if they are investing in the company's stock, then the amounts are variable. And the bankruptcy behavior is like shareholder bankruptcy payouts rather than creditor bankruptcy payouts. So if that's true, then it's hard to say that that kind of pay acts is inside debt. So we're going to explore whether or not executives are investing these amounts in company stock rather than fixed amounts that would be more like inside debt. So at a very summary level, here's the summary chart that's not too persuasive, it's at a very high level, but something that's worth noting for you. I've given you here in the shaded bars the return, that is the percentage return executives got in their retirement, in their defined contribution retirement plans in each year of my sample. And then I've given you the average stock returns of the companies. And you can see generally that executives do well in years where the stock market does well, and less well in years where it does less well. So for example, in 2006, executives enjoyed just about 20% or greater returns on their investments, these retirement payments. That was a good year to be in the US stock market. Stocks were also up that year. You can see in 2008, the executives, which was a tough year to be in the US stock market, executives lost about 25% in these accounts, and the stock market had a bad year that year. Now, this of course doesn't show that the executives were invested in their own company stock. It shows that they invested in something that varies a great deal over time. But it doesn't prove whether or not the executives actually invested these payments in their own company stock. So, in regressions that we've run in connection with the study, we actually examined whether or not the executives' returns on their defined contribution payments are linked meaningfully in a statistical fashion to the company stock returns. So, I've given you here 2 regression models, just high-level results. I'm glad to talk about them in more detail if that would be interesting. I've got one regression that includes all the firms in my sample, which is the S&P 1500 and the award. Then another group that's just the S&P 500. The dependent variable in the regressions is the executive's own returns on their stock. The executive's own return on their investments in their retirement payments. We've controlled separately for the market's returns as a whole. So here we've put to one side, controlling separately, the way the market has behaved in each of the years in our sample. And so what I'm giving you in the very top line here is the market-isolated relationship between the company's stock return and the executive's returns on his retirement payment. So what you see is a very positive and statistically and economically significant relationship between the two. That is, it looks like these payments, the value of the payments depends very significantly on the value of the executive's own company's stock. And you can see why that would be problematic for the inside debt hypothesis, because these are not payments of fixed amount, but instead payments that vary very considerably with the company's stock price. Happy to talk more about that in the Q&A. I can say more about the methods, but this relationship is a very robust one. Now, you might say that this regression, this kind of outcome, proves generally that the executives, some executives have invested in the company's, have invested their retirement pay in the company's stock. But you might wonder, well, look, rather, how many executives are really putting lots of their money in the company's stock? So here what we've done is we've just taken an individual correlation for every executive between the returns they got on their retirement pay and the company's stock. So we've just done individual executives one by one. What is that correlation? And you can see on the right side of my chart here, about 30% of the sample, so 30% of the executives in our study, have a 0.9 or greater correlation between their own stock returns, between their own returns on defined contribution payments, and the company's stock returns in that year. So for that group of executives, where the relationship between these two things is 90% or better, it seems pretty likely that what they've done with the payments is invested in the company's stock. And as I say, that's 30% of the executives in our group. And as I was noting before, this is a very substantial difference between payments that would be fixed amounts over time and these types of payments. These are not inside debt. These are holdings of inside equity. And the previous literature, by having treated them as inside debt, has actually, in my view, failed to pay attention to the detail in the way the executives are using these plans. So one thing that I wanted to figure out is how much has the previous work erred by doing this? That is, how much has previous work that's treated defined contribution plans that are like these, that are on the right-hand side of my chart? For these individuals, if we just look at them, they're clearly invested in the company's stock. How much have previous researchers erred in estimating their incentives by treating these payments as debt rather than equity, which is what it is? One way that economists who worked in this area have studied executives' incentives is they've figured out for each individual executive what is their personal leverage ratio. So they've said, look, let's take the total inside debt the executive holds, the value of that, divided by the equity she holds, and that tells us in general how levered the executive's own payoff structures are from the company's returns. This gives us a sense for what the returns on all the claims on the company, and gives us a sense for what their incentives are. So just looking at the folks in my study who've got 90% correlation or better, just those folks who are very confident have got a lot of equity in these payments, I've recalculated the individual leverage ratio for the executives using the methods in other studies. So on the left-hand side of my little chart here, you can see that if I include these defined contribution payments as debt rather than equity, which is what they really are, I come up with an average executive leverage ratio of 1.12. And that's the number that many studies in this area have used. That is, the value of her inside debt compared to her inside equity is greater than 1. But that can't be right. That's not right, because for these individuals, we think it's mostly made up of stock. Now, another series of papers have taken a different approach. They just exclude defined contribution from the calculation, figuring that it's that they don't know whether it's debt or equity. That gives you an average ratio of 0.51, but that's not right either, because really what we should do with this stuff is take it out of the top of this quotient and put it in the bottom, because it's equity. And if you do that, you get the number on the right side of my table, 0.3. What this shows is that previous studies that have treated this stuff as inside debt rather than equity have erred pretty significantly, actually, in estimating the average incentives of executives.
How did they even think it was debt? That's what I don't understand. If we have a guy buying his own stock in the company, and like so many company plans are like that, someone said this is inside debt, like, how do they even think that?
Yes.
I mean, that's a stupid question, but I mean, it seems like anyone who spent 10 minutes in a company and knows that you get stock, and then we say you're a debt holder. I mean, that's like that's like you don't know the difference between debt and equity. I mean, it's an impossible question to answer, but it seems so stupid.
Yeah, no, so I agree it's a striking mistake. To be fair to the folks who have written in this area before,
Yeah.
two things I should note. First, the data this is a brand new area. So none of this was disclosed prior to 2006. The data that's come out is very spotty, and they're kind of just trying to use what they've got. Second, they, in more recent updates to previous work, they realized part of the problem, and that's why some of them have done what I've done in the middle box here.
Right.
They've just taken the stuff out of the inside debt calculation. Now, as I suggested, I don't think that's satisfying, especially not for the individuals for whom we can show it's equity. But yeah, so I think this literature is pretty new, and that's why they're making the mistakes they are. Okay, so I said I was going to talk about two things. First of all, these defined contribution payments and whether they're fixed amounts that lead to debt-like payoffs. And then I said I was going to talk about the timing of payments. Remember, we said that inside debt would pay over time, just like corporate debt does. And I would tell you a little bit about whether or not retirement pay for top executives pays over time or instead is paid more quickly. I'm going to do that by looking at the other type of retirement pay. That's the defined benefit type, the pension-like payments, remember? What we said about those is the executive gets promised by the company that they'll be paid some pension in their
I ask
retirement.
a quick, I mean, you're distinguishing here between defined contribution and defined benefit. I don't know what's happening in the United States, but in the UK, all pensions are now defined, they're all defined contribution.
Yeah.
So I mean, I don't get it. I mean, you're saying those are pension-like and defined contribution aren't? That distinction makes no sense in the UK. Maybe it does in the US, it makes no sense here.
So it's certainly, I've read a little bit about what's going on in the UK and moved to defined contribution plans. That's also happening in the United States. Defined contribution plans are much more common even for top executives. Say nothing of employees, for which they are now almost completely universal. But I think they are different structurally, right? So a defined contribution plan is one in which the retiree, the recipient says, I'm going to defer pay today, take that certain amount, put in an investment instrument, and that's going to define my balance in the future, right? A pension is structurally a little bit different. There, the entity makes a promise to the individual. We'll pay you a certain amount in the future when you retire.
No, here they're both pensions, and here defined benefit is the gold standard, is what you really want. So the way I can see you going is you're suggesting here that the managerial power one is going to have it ending up in a situation where they're going to end up as defined benefit, right? It's defined contribution. That's the end point you want to get to, right?
Mm-hmm. No. I'm just trying to see whether or not this notion that retirement pay makes people creditors of the firm and therefore makes them more careful is true. It's whether or not the actual structure of the payments look like that.
Well, they're creditors of the firm. It's just what the debt looks like.
Yeah, but that really matters, right?
Yeah, well, actually, see, the thing is, the way I think you're going is that you're going to say that if it looks a lot like debt, then if it looks a lot like equity, then that suggests managerial power, right?
Yes.
Right. To me, if I was an executive, I would want to be so far away from my company, so far away. I would want debt. I would want, and so to me, it would be good for the company and bad for the managerial power explanation if it looked like a defined contribution. Why the heck are they putting money in their own stock? I mean, it's the last thing they should be
So
doing.
that's a very good question. So it's useful for me to answer it now before I get into the stuff. So
sure.
No, that's very useful. So it's a good question. So one thing, now I've just shown you the stuff about defined contribution. I've shown you that it looks like mostly like stock. And I think Brian's question is, well, why do the executives do this? I mean, that is, the executives are already exposed to the company's value, right? First of all, they have stock holdings. They're actually paid in stock, so they've got stock by that route, right? Second of all, their reputation is tied to the company. If the company fails, they're just going to suffer a personal loss of their reputation. And by the way, that's not diversifiable. So why do executives do this, I think is the question.
Partly, and basically, it looks to me like this is exactly what the optimal contract, and people go, this is great, this is just what we want. We want them to be heavily invested in it like an equity sort of, not the other one. That to me is what you would expect to see from optimal contracting. So I'm not, in this previous literature, you said it's like that. I'm not familiar with that, but I tell you, this to me would be going, if I was the optimal contractor, people are going, this is great, this is what I like to see.
Yeah, they're not for the following reasons. So it's a fair question. He's saying, look, he said that it's a market failure, that it's a managerial power story. You're getting executives to align their interests with those of the shareholders. They were becoming shareholders. What's suboptimal about that?
Or remaining shareholders.
Very fair about that. No. So it's a very good question. So a few things to note about this. First, I wondered, when I had this finding, I thought to myself, what are the executives doing? Like, why would they do this? So I read some of the disclosures, some of the proxy statements, and the answer is that the companies frequently will require or encourage executives to take these amounts and put them in these plans. So it's not totally a free choice by the executives. But you might still say, okay, that shows the directors are bargaining hard. They're insisting on putting on aligning the executives' incentives with those of the company. What I'll say about that is if you're a public company director and you want to get your executive to own company stock, this is one of the least efficient ways to go about this. You can get them to own company stock, for example, by giving them some, right? By actually paying them in stock, which companies do, by the way. You can get them to, you can have a purchase requirement. Many public companies have that. If you wanted to get them to be stockholders, this is a very inefficient way to do it. But, as I'll show you in a second, it's a way to do it that causes some of the gains to the executive from the stock not to ever be disclosed to the shareholders. So I think that would be the managerial power answer. They would say, look, if you want to put somebody in stock, there's really efficient ways to do that are subject to stringent disclosure. This is not an efficient way to do it from a tax point of view, but it's a way to do it that hides gains from the public. I'm going to say something about that right at the end of the talk.
But are the defined contributions hidden too? Defined benefit way of doing it hidden as well? I'm continuing his point, which is to say, if you want to hide it, let's say you want to, say you're very sneaky, and you want to hide what you're doing, but you also want the best for you. Then I think Brian's idea is it would be best to do a defined benefit line of just right.
That's right.
Nice.
And with the other thing, I mean, I guess it depends how you look at it. Let's say that they want to give him $10 million, okay? And so, I mean, I take the point that there's more efficient ways of doing the stock.
Yeah.
But maybe the way to think about it, I mean, would be, all right, we're going to give the $9 million not of this sort, of this defined, pension-like, whatever we want to call it. 9 million lump, we'll do whatever we want with it. Then we have this million that we're going to give them each year that's going to it's going to be deferred. And then what you do within the parameters of that million is you go, well, how can we make this as closely aligned to stockholders' interests as possible with the million already with our head fixed on that? And then what you would do is, if you were the executive and you were doing it in your own interest, and you were already, you want to get rid of the diversification problem, say, keep me away from company stock. Then the directors push hard and say, no, we want you locked in for this million into the company stock. And so we're pushing hard. So I guess, I take the point that there are much better ways of giving them stock. Right? But if you do it as a pie, and this is your deferred slice, and you, with that deferred slice, can make it really stock-like, that would seem like optimal contract. So I'm sure to explain that, but that's how I would. That's one way of characterizing.
No, that's very useful. I'll say more about this in a little bit, about the way in which this way of giving them stock hides significant pay that they actually get, so that's a little more consistent. But let me say one more thing about this, which is, I think actually this is a helpful framing point, Brian. When I say that there are two theories, managerial power and optimal contracting, I don't mean to, that's just to kind of give you the frame for where the literature is. That's the kind of debate that exists in this literature. But the hypothesis I'm evaluating here is not optimal contracting full stop. That is not the possibility. This could be optimal in another way. I'm evaluating a narrower claim, which is it's optimal because it's inside debt. That claim is really the one I'm evaluating closely, and you're right to say that I framed it more broadly than that, but that's just for context. But I think we'd agree, Brian, whatever you think about this, it might be optimal, but it's not credit. It's not debt.
Yeah.
So
No, I'm with you there.
Yeah.
So we just keep going. I'm with you.
Yeah.
It's how you characterize it.
But that framing point's very, very helpful. So I remember I said earlier we're going to look at two types of pay, the defined contribution stuff Brian was just asking about, and then defined benefit payments. Those are the ones, remember, that are like pensions. And here we're going to evaluate whether or not the payouts from retirement pay are made over time, the way debt payments are made to corporate creditors, or whether or not they're made with different timing. Now, again, that decision, executives' decision as to when to get paid is not disclosed. We get some stuff on retirement pay, but not the important stuff, not that stuff. So what I'm going to do is try and figure it out, kind of back into it this way. The executive in public companies, they agree to get paid at some certain time. Then the executive leaves. And in the moment they leave, that year, because they're still subject to disclosure rules, I see how much they're paid in that first year. So I can wait for an executive to retire, she leaves the company, I see how much she's paid, and I know how much she's owed. So really, I do this simple calculation. I divide one by the other. I say, look, I know how much she's owed, that's in the denominator. I know how much she got in her first year, that's the numerator. I figure out what percentage she was paid in the first year she walked out the door. And this gives me a glimpse at what the payment schedule over time looks like for this kind of payment. Now, one thing you might say at this point that I just want to make a note about is, well, how do you know what they get in the first year is indicative of the schedule over time? So I was lucky in a couple of cases. In about 100 of my cases, the executives retired as executives but stayed on the board of directors, so they still were subject to disclosure, so I could follow them like for a few years out. And what we find in general, when I talk to lawyers, they say this is standard, the payments are very fixed over time. That is, the percentages are fixed over time. So if you get half your retirement pay and you retire, you're on a 2-year schedule. You're likely to get paid out in 2 years. So I use this kind of way of backing into how quickly they're paid to see how fast are executives generally paid their retirement pay in public companies. And the answer is fast. So I've got about 250 retirements over a 6-year period. This chart, what I've got on the x-axis is the percentage of everything they're owed that they're paid in that first year. So you can see that the most common schedule that I find in the data set is 100%. That is, executives in public companies, more than 20% of them get everything they're owed in that defined benefit plan the day they walk out the door. You can see also there's a reasonable distribution. The median is about 3 years. So the median executive gets paid in a little less than 3 years. So just descriptively, you can see, at least for this sample of executives, the notion that they're paid over time and that this aligns their incentives with those of debt holders just isn't descriptively true.
Even with defined benefit.
Yeah.
So in other words, it's just it's a golden parachute or whatever.
Yeah.
I see.
Yeah.
That's what that big line is, a golden parachute.
That's right. That's right.
So in no way is it like a defined benefit pension plan.
No, not at all. But you can see why the economists made the mistake. Because if you're reading a disclosure and someone says, well, is this like a pension? Any person would think it's like a pension. That is like you retire and you get like, I don't know, a couple $1,000 a month for 30 years.
Severance pay.
But
So the economists thought that severance pay was a retirement plan, is what you showed.
I think that's right. So it's funny that you have this reaction that it's like severance pay, because so whenever I show this slide, a bunch of people have had, Vic Goldberg had this reaction too, like, oh, it's just a severance check. And again, like that could be totally optimal for lots of important reasons. So one thing I did just to figure this out is what I did, Tim, was I took this group of payments and I regressed them against actual golden parachutes, like things the companies call golden parachutes. Because if they're substitutes, you'd think I find an inverse relationship, but I don't see anything. Actually, I don't see the relationship. So that's interesting to me because a true optimal contracting story would be, hey, maybe they're just substitutes. Like they call them this over here, they call them that over here, but they're just severance pay. But it doesn't seem like they're acting as substitutes.
Is it then the terminology acceleration the right terminology to use? Because prior to departure, or time of departure, they're essentially dictating how soon they collect everything. So after departure, there is really no acceleration opportunity because it's already been locked in, if you know what I mean.
Mm-hmm.
So when you say this was one of the qualification and one of the criteria for the inside debt argument is that they have no opportunity for acceleration. That's essentially locked in from the time you leave. So from the beginning, that's really not the question to ask. Should it be whether or not there is a minimum period over which they're due to receive, rather than whether or not there is an opportunity for acceleration?
I see. So you're right, those are two separate points. So what I said before was that the executives, that we would ask whether, I said we look at two things, right? Whether they're paid over time and then whether or not they can accelerate the payments.
Yeah.
You've said here, look, you're not proving they can accelerate anything.
Right.
You're just showing that they get paid fast. But something that I didn't put in the slides, but it's in the paper, is I talk a little bit about the fact that actually every executive at every public company has an embedded option to accelerate their payments. And the reason is that typically the directors of public companies will permit the executive to accelerate in this way if they want to. So even those on this side of the slide, even those over here who are being paid very relatively slowly can accelerate their pay can get them more quickly after they retire from the firm. Now, I should say something about this, which is that the U.S. Congress has gotten involved, which is always bad news on executive compensation and many other things, but especially executive compensation. So the U.S. Congress has said, if an executive does this, we're going to tax them. We're going to penalize them for it because we don't like that they do this. And they enacted this law after 2 top Enron executives, right before the company imploded, accelerated about $100 million worth of deferred compensation and got paid right away, right before the firm went bankrupt. Congress was upset. They passed this law called Section 409A of the Internal Tax Code. And the Congress says, if you do something like that, we're going to penalize you 20% on the payments you owed. Now that actually helps this problem a little bit because many executives who previously would have accelerated to save themselves from bankruptcy will evaluate the tax burden and say, well, I shouldn't do it now because I can accelerate and save money that I would lose in bankruptcy, but I'm going to have to pay a big tax bill to the government. But I want you to see that it's not a complete solution. In fact, what's so upsetting to me about this section of the tax code, which I leave out of here because taxation of executive compensation is just this painful, but what's tragic about it is it actually allows executives to accelerate in the worst bankruptcy cases. The cases where the bankruptcy will be deepest or most likely. Because think about it, when the executive's choosing whether to accelerate, she's going to evaluate her tax bill, 20% times what she's accelerating, by what she'll lose in bankruptcy. The more she loses in bankruptcy, the worse the bankruptcy is, the bigger these costs are going to be, and the more likely she'll be willing to pay the tax bill. So one irony of Section 409A, and I've written this in comments that nobody reads to the Congress when they ask about this stuff, is Enron would play out the exact same way under this bill. Yeah, because the Enron executives knew that that was going to be a horrific bankruptcy.
I know it's a tangent, but why is that a fraudulent conveyance? I
No.
thought bankruptcy is fraudulent, if you're paying out huge amounts. Just have this in friends of mine.
Yeah, yeah, it's not at all attention. I've got a new paragraph in the piece actually about this. So fraudulent bankruptcy law in the U.S. can claw back these amounts under certain circumstances. They're known as fraudulent conveyances. That is, what the company has done is handed money to one of its creditors and not another in a fraudulent fashion in order to avoid the bankruptcy result. You can also use a fraudulent transfer claim for this purpose. There are a couple of problems with it. One is that companies are reluctant to litigate against the executives. So Enron declined to litigate against the executives. The bankruptcy trustees did the same. The second is there's a 1 year in advance. There's a presumption that it's within 1 year, and the Enron guys did it 1 year and 3 months in advance of the bankruptcy. But the bankruptcy could provide a solution to this. It just doesn't at the moment. And actually, when I asked practitioners about this, they couldn't think of many cases in which executives have been successfully gone after in a fraudulent. Do you know one? I mean,
Yeah, no, I don't want to talk about it. There was someone who didn't know what they were doing. Their company's about to go bankrupt, so they wrote a huge check for themselves.
Oh.
Yeah. Like small things.
Yeah. Okay, so you can see descriptively these don't behave like standard debt contracts, and so on your acceleration point, I would say executives still can do this, but there's a tax implication. But even so, even for the ones who can accelerate, they're getting paid pretty quickly. Now you might have the reaction, look, if executives are able to do this, the debt markets are not going to sit idly by, right? Like they can see that this is not real inside debt, that the executives don't really have incentives to be more careful. And maybe they can't see it because it's not disclosed, but the markets, might react to it. That is, the company might be riskier if executives behave this way. So I ran a few regressions to see whether that was true. What I did was I used 4 different methods of measuring firm risk. The volatility of their equity, their leverage, measured a couple of different ways in the literature, and the price of a credit default swap on the company's debt. And I said, is there a positive relationship between the executive's choice to get paid quicker and the firm's risk? Because my intuition would be there would be. For 2 reasons. First, if the executive's getting paid quicker, she's not so worried about risk, so she'll take some, and the market will react. Second, the market, if they know what the executive is up to, will say, well, you have no reason to be careful. And they'll act accordingly. That is, make the firm appear riskier. And indeed, in these regression models, I'm happy to talk more about them in Q&A, I find a very robust relationship across all 4 of these risk measures between the speed with which the executives define benefit payments are made and the riskiness of the firm. That is, how quickly they get paid, the percentage they get in that first year out the door, is positively correlated and statistically significantly correlated with the risk of the firm, measured any of these 4 ways. I want to make a note about which I should be careful here, which is that here I've shown correlation, but not causation. So, you can tell 2 stories about why this is true. First, it could be The executives choose to get paid right away. They know they're safe, that they can just walk out the door and get most of their money. So they do risky things. And the market responds. That's one way the causation could run. But another way the causation could run is the market sees that the executive or senses or figures out that the executive will get paid quickly, and therefore raises the price of its credit default swaps and trades the equity in a more volatile fashion because they think the company is riskier. I can't show which way the cause runs. What I can show is that it's important, that there's an important relationship between the speed with which these guys get paid, these retirement payments are made, and the riskiness of the firm. And here I should make another note, which is an inside debt theorist could look at this regression and say, see, we're right. That is, they'd say, look, if inside debt didn't work, if it didn't provide some incentives to be careful, there'd be no relationship between risk and the structure of the payments. And I guess what I'd say about that is that's fine for me, but when you write about this stuff, you've got to distinguish between inside debt that's paid right away and inside debt that's paid over time, right? Stuff that's paid right away is the markets are telling us, not inside debt. It doesn't cause executives to be careful. And we shouldn't think that it would, because it doesn't match the payment schedule of debt. So I would say to these economists, you should distinguish between those types of payments and payments that are made over time, which might actually have the incentive effects that you're describing. So I said earlier in response to Brian's question, I was going to show a piece of data that actually I think would be consistent with the managerial power view rather than the optimal contracting view. And what I said was current disclosure rules, although they disclose some information about retirement pay, leave out from the total pay calculation an important benefit executives get when they buy stock through their defined contribution plans. When executives own stock through their defined contribution plans, for a complicated tax reason in the United States, so what I'll say, I should explain a little more. So 401ks in the United States, which is the account that Tim was referring to before, are capped at a particular level. You can only get the tax benefits of this investment up to $16,500 a year for this tax year. But these amounts the executives are saving, I showed you before, are way more than that. What the companies do is they take that disadvantageous tax treatment that applies above that limit, and they absorb it for the executive. So the executive gets treated like everything she's saving is a 401k. And the company pays additional tax in order to give her this treatment. That move, the company's trade of we'll pay additional tax so that you can get 401k-like treatment on all your stock, causes a cost to the company, as you would imagine, in additional tax bills. Yeah. Nobody's everyone agrees that this is true, but no one's tried to estimate how much it is. And this number is not disclosed in public filing. So it's not included in the CEO's pay, it's not included in the company's costs, it's hidden in the accounting line. So what we've done in this study is trying to estimate how much it is. That is just using very conservative estimates, how much have executives gotten through investments in the companies, through investing in retirement pay in the company's stock. That's not disclosed. And the answer is about $400 million over our sample period. Now, as I say on the chart here, about half of that is for CEOs only. So $200 million just to the CEOs of the companies in my sample over this period. Now, I should say about this a couple of things. First of all, a few $100 million, $200 or $400 million might sound like a lot of money, but in a big sample of public companies, one could say that it's not that big a deal, or that it's not very significant or not material. I think that's true. The claim I'm making here is not that this is a big number, or that it's suboptimal, or it's clearly waste, or anything like that. All I need to say is it's not disclosed. That is, it's hard for investors to figure it out. So if you were wondering why do companies invest executives in their company stock in their retirement plans, it could be for incentive alignment reasons, but it could also be for this reason, for the reason that it allows you to convey compensation to the executive that's not fully disclosed to investors or the public. So very quickly, some high-level implications. First, one thing that's striking to me about this is everything I've been telling you is not the subject of these new disclosure rules. To be fair to the SEC, they just have tried one time with these disclosure rules, and they usually don't get things right on the first try. So they disclose stuff like, how much the executive got that year on investment returns in the retirement pay, but not whether it's stock or debt. Right? So I know you can figure out all these things about these disclosures are hundreds of pages long, but I can't figure out what the incentive effects of these things are. I say first, the SEC should fix those rules. Second, in a very scary development, the Federal Reserve, which now regulates banker pay in the United States, wrote a white paper about a year ago where they said, well, we're very concerned about banker risk-taking, but the good news is there are some academic papers that show retirement pay acts like inside debt and stops people from taking too much risk. So the good news is that in banks that have these retirement plans, bankers will be more careful. Okay, so that's wrong. That's a huge mistake. First, without knowing the structure of the payments, you can't say that at all, right? You have no idea whether they act like that. Second, what I've shown you here is that a lot of it is stock, which for bankers will encourage them to take more risk. Because stockholders of a bank internalize the benefits of sharing risk with the government. So bank regulators should be more careful when thinking about these kinds of retirement pay. And finally, so should we. So should commentators. That is, we should distinguish between inside debt that's actually fixed and behaves like inside debt, and retirement pay that's structured the way that much of the pay that I've shown you here is, which really doesn't, I don't think it can be plausibly said, it's likely to have the incentive effects that economists have been describing. So that's the paper. Any questions?